welcome to this deep dive. Today, we're cracking open the fascinating world of trading venues. We're drawing insights from trading venue FinCrime intelligence.
Yeah, absolutely. And when you think about these venues, they're really like the central hub of finance, right?
Exactly.
The platforms where all sorts of financial instruments get bought and sold, your stocks, bonds, but also more complex stuff like derivatives, commodities.
Hmm.
What's really interesting, I think, is just how many different types there are. You've got the big traditional exchanges everyone knows.
Right, like on the news.
Yeah, exactly. Then there are these super fast electronic platforms humming away,
Yeah.
and even sort of behind the scenes markets over the counter stuff. And each one has its own rule book, basically.
Okay, so our goal today, our mission, if you like, is to get a really clear picture of these different kinds of venues.
Mm-hmm.
And to understand the rules they play by, we'll definitely talk about things like MiFID II in Europe, the Securities Exchange Act in the U.S., and crucially, look at the financial crime risks, where things can go wrong.
Yeah, that's vital.
Think of this as, well, your quick guide to a really key part of the whole financial world.
That's a great way to put it, because if you understand
Yeah.
this plumbing, these trading venues,
Yeah.
you're just much better placed to grasp the whole financial ecosystem, the good stuff, the opportunities, and yeah, the risks too.
Okay, so let's dive in. Different types of marketplaces. First up, regulated markets,
Mm-hmm.
RMs. What are these exactly?
So RMs, they're your classic, really established exchanges. Think London Stock Exchange, New York Stock Exchange, those kinds of
The
places.
big names.
The big names, yeah. What really defines them is a very structured way of operating. It's transparent. They're under really tight regulatory control.
Okay.
And typically you'll see them trading the core instruments equities, so stocks and shares,
Right.
bonds and derivatives too. They're kind of the bedrock.
Got it. The cornerstones. Okay, then we have multilateral trading facilities, MTFs. These sound a bit more digital.
Exactly. MTFs are basically electronic platforms. Think of them like digital matchmakers.
Mm.
They bring lots of buyers and sellers together electronically, often run by big financial institutions, and they absolutely have to follow regulations. And yeah, MiFID 30 in Europe really shaped things here.
Oh, okay.
The thing about MTFs is they offer maybe a bit more flexibility than those really traditional exchanges, and they've become super popular as, well, everything's gone more digital in trading, efficient electronic marketplaces.
Flexibility, right.
Right.
Now, organized trading facilities, OTFs. The name kind of suggests they were, I don't know, specifically set up by regulation.
You've absolutely hit the nail on the head there. OTFs were actually introduced by MiFID II.
Ah.
Yeah. Their main job is trading non-equity instruments. So things like bonds, certain derivatives, stuff that isn't like owning a piece of a company, like a stock.
Okay, different asset types.
Exactly. And the key difference here often is there's a bit more discretion, more judgment involved in how trades actually get executed. They tend to focus more on professional clients, people who really understand these maybe more complex instruments.
So it's less of that instant automatic matching you might see on an MTF. Less robotic.
Correct. It can be a bit more of a negotiated feel. Okay, then there are systematic internalizers, or SIs. Now, the source material says they aren't technically a trading venue in the old sense, so what's the story there?
Yeah, that's a good point. Think of SIs, like investment firms acting almost like their own little trading desk in-house.
Okay.
They trade using their own money on their own account, and they often fill client orders directly from their own inventory of securities. They don't necessarily go through a formal exchange or an MTF for that specific trade.
Wow, right.
Their role also got kind of formalized, more defined under MiFID II. So it's just another channel for trades to happen.
So they're sometimes the buyer and the seller,
Hmm.
effectively, dealing from their own stock. In essence, yeah, for those specific trades, it just adds another layer, another way the market works. And then, well, then there's the really new frontier. Crypto asset trading platforms. Feels like a whole different ballgame.
Oh, absolutely. You've got everything from, the more regulated crypto exchanges that feel a bit familiar, all the way to these decentralized exchanges, DEXs,
Yeah.
which run on smart contracts. That sounds pretty complex.
It is. Smart contracts are basically just code on a blockchain that automatically executes trades when certain conditions are met. No central middleman needed.
Wow.
Yeah, it can feel a bit like the Wild West sometimes, or maybe the early days of the internet.
Yeah.
And it definitely throws up a unique set of challenges. You've got this huge range of platforms, some regulated, some not so much. And as the source points out, they come with their own specific financial crime risks that, maybe traditional venues don't face in quite the same way.
Okay, so we've got this real mix of venues.
Yeah.
But what holds it all together? What are the fundamental rules? Why is regulation so important here?
Oh, regulation is just.
Hmm.
It's absolutely critical. It's fundamentally about making sure these markets work fairly,
Right.
that they're transparent, that they don't
Hmm.
become, playgrounds for illegal stuff. It's also about managing systemic risk.
Yeah.
The worry that if one bit fails, it could drag down the whole system.
Yeah, the domino effect.
Exactly. And ultimately, it's about protecting investors, whether that's big institutions or just, ordinary people.
And our source really highlights MiFID II in the EU and the Securities Exchange Act in the US. What kind of specific things do these rules actually cover?
Well, MiFID II, for instance, it's really broad. It covers things like pre- and post-trade transparency. So making information about trades public both before they happen and afterwards.
Okay, shining a light on things.
Exactly. Then there's best execution firms have to try their best, take all reasonable steps to get the best possible deal for their clients when they execute a trade.
Makes sense.
It also sets rules for how order books should be managed. And really importantly, it mandates something called suspicious transaction and order reporting, or STORs.
Stores.
Yeah, think of stores like an alarm system. If a trading venue or a firm sees trading activity that looks dodgy, like market abuse, they have to report it to the regulators.
So they have a legal duty to flag suspicious stuff. And the Securities Exchange Act in the US, similar kind of idea over there.
Pretty much, yes. It's the equivalent framework, really. Enforced by bodies like the SEC and FINRA, it sets out the rules for trading venues in the U.S., all aiming for those same goals: market integrity, investor protection.
Okay. Now, with all this money sloshing around these different platforms, it probably doesn't come as a surprise that financial crime is a big worry. What are the main risks we're talking about?
Unfortunately, yeah, it's a constant battle. If the controls aren't strong enough, these venues can definitely be exploited. The source mentions several key risks. Market manipulation is a huge one.
How does that work?
Well, it involves tactics like spoofing. Imagine someone pretending to want to sell loads of shares just to trick the market into thinking the price should go down, but they have no intention of actually selling.
Creating a false impression.
Exactly. Or layering, which is kind of a more complex version. Wash trading is another. That's where someone is basically trading with themselves to create fake volume or push the price around.
Hmm.
All these things just distort how prices should naturally be set by real supply and demand.
Right, it's like rigging the game. And then, of course, there's insider trading. Everyone's heard of that.
Yep. The classic illegal use of non-public important information to make a profit or avoid a loss. It just completely undermines fairness, doesn't it?
Totally unfair advantage.
Yeah.
And what about money laundering? How do trading venues fit into that picture?
Well, some venues, maybe those with weaker checks or ones that allow really fast, anonymous-looking cross-border trades, they can be attractive to criminals trying to clean dirty money. They might try to disguise the source of funds by funneling them through buying and selling securities, making it look legitimate.
And lastly, fraudulent securities offerings. I guess this is maybe more of a risk in those less regulated areas, like some crypto platforms.
That's often where you see it, yes. In
Yeah.
places with looser oversight, there's just a higher risk of scammers trying to sell fake investments or misrepresent what they're offering just to rip people off.
So, faced with all these threats, what are trading venues actually expected to do about it? What kind of defenses should they have?
The source lays out some key things. They really need sophisticated surveillance technology, systems that can crunch through all the trading data in real time and spot weird patterns.
Okay, tech is key.
Definitely. And robust know your customer KYC processes, basically verifying who your clients actually are.
Right, ID checks.
Absolutely. They also need to cooperate fully with regulators and law enforcement when investigations happen. And they need to constantly be assessing their own risks, doing audits. It's not a one-off thing, it's continuous.
Sounds like a constant vigilance job. A real cat and mouse game. Now, looking forward, technology's changing everything, isn't it? How's that hitting trading venues?
Oh, massively. It's driving huge shifts. The source points to the growing use of artificial intelligence, AI.
AI. How?
Well, AI and machine learning are getting much better at that market surveillance we talked about. Spotting anomalies in huge data sets, identifying new fraud patterns maybe quicker than humans could.
Right, like a digital detective keeping an eye on the market. That's pretty interesting. What else is changing?
Another really big trend is tokenization.
Tokenization.
Yeah, basically turning traditional assets like, say, a piece of real estate or a bond into digital tokens that can be traded on a blockchain platform.
Oh.
This is really blurring the lines. It makes you ask, well, what even is a trading venue now? And how do you regulate these new kinds of exchanges? It's like turning something physical into a digital counter you can trade easily.
Sounds like the regulators have got their work cut out for them keeping up.
They certainly do. And because markets are so global now, so interconnected, there's also this push for more harmonization of rules, regulators in different countries talking to each other more, trying to get consistent oversight, especially for these platforms that operate across borders or deal in digital assets.
Makes sense. And we have to mention decentralized finance, DeFi. That feels like it could fundamentally change the whole trading venue model.
Oh, absolutely. DeFi platforms, well, the whole point is to get rid of the traditional middlemen, right?
Yeah.
They run on the smart contracts on blockchains,
Yeah.
which throws up massive questions about, well, who is accountable if something goes wrong? How do you do anti-money laundering checks? How do you protect investors when there's no central company in charge? It's moving incredibly fast, and it's a huge challenge for the way things have always been done.
Okay, so pulling it all together. Trading venues are this incredibly varied, constantly changing landscape right at the core of the financial system. They're heavily regulated, but they're also facing this nonstop battle against financial crime, and they're having to adapt like crazy to new technology.
That sums it up perfectly. They're the essential infrastructure, really, for modern finance. Understanding the different types, the rules, the risks. It's just so important if you want to understand how finance actually works today.
Right. And maybe a final thought for you, the listener, to chew on. With DeFi growing so fast and this trend of tokenizing everything, how might our basic idea of what a trading venue even is change in the next few years? And what new opportunities and let's be honest, new risks might pop up for all of us as participants in these evolving markets? Definitely something to keep an eye on, the market trends and how the rules try to keep pace. Thanks for joining us in this deep dive.